Every system has an architecture. Most people see the facade. This is what's underneath. On April 6, 2006, the Pentagon submitted a budget request that broke the pattern of 80 years. $20.2 billion, not for missiles, not for ships, not for soldiers, for mines, refineries, and minerals. A 1,247% increase from the previous year, led by the co-founder of a $65 billion private equity firm. The Pentagon stopped buying weapons, it started buying the companies that build them, and the architecture being constructed looks identical to the one America built its entire foreign policy to dismantle. The Treasury is the new arsenal, capital is the new ammunition. The visible story is straightforward. It is the one repeated in every press release, every congressional hearing, every cable news segment. America is responding to China's mineral monopoly. The numbers support the story. China controls roughly 90% of global rare earth processing and 99% of the heavy rare earths. The materials that do not have substitutes, the ones that do not appear on commodity exchanges, the ones that are negotiated bilaterally in private between states. The vulnerability is real. Each F-35 fighter contains roughly 50 pounds of samarium cobalt magnets. The Ford-class carrier scores 0.915 on platform vulnerability indexing, the highest of any system measured. A single supply disruption from a single processor in a single province could ground the most expensive military hardware ever built. So the response makes sense. America must onshore. America must reindustrialize. America must rebuild the supply chain it dismantled across 3 decades of efficient global trade. This is the consensus. Republicans, Democrats, defense hawks, industrial policy advocates. There is no political opposition, there is no controversy. This is the facade. It is accurate and it is incomplete, because the question that the consensus does not ask is the one that matters most. How is America actually doing this? What does the machinery look like? Whose money flows where? Under what authority? With what guarantees? Into what kinds of contracts? The answer is documented. The receipts are public. They have been public for 9 months. And almost no one has assembled them in one place. In July of 2025, the Department of Defense entered into an agreement with MP Materials. The transaction was framed as a strategic investment. The mechanism was unprecedented. The Department of Defense agreed to pay $110 per kilogram for neodymium praseodymium oxide. The market was paying $60, but the MP Materials deal wasn't a subsidy. It was something the United States had never legally done before, and it was a test for something far larger. It was an offtake at guaranteed price. The federal government, acting through the Pentagon, contractually obligated itself to purchase a strategic mineral above market rate for a fixed term, regardless of where the spot market moved. The structure inserted the state directly into the commodity price formation mechanism for one of the most strategically critical materials in the supply chain. The Wall Street Journal called it a strategic investment. The Cato Institute, 3 months later, would use a different phrase. We will return to that phrase. The pattern that began in July did not stay in July. In October, the Department of War, the Pentagon's renamed acquisition arm, announced an equity stake in Trilogy Metals, a junior mining company headquartered in Vancouver. The transaction took 10% of the company for $35.6 million. The Pentagon paid $35.6 million for 10% of Trilogy Metals, but Trilogy's mine wasn't even producing yet. The Pentagon wasn't buying the mine, it was buying something the mine couldn't reach without. The Ambler Road, 211 miles of unbuilt industrial corridor through the Brooks Range of Alaska. Without that road, the deposit cannot move ore. With that road, the deposit becomes one of the largest copper, zinc, and germanium reserves on American soil. The Pentagon did not buy the asset, it bought the access, it bought the precondition. It bought the geometry that turns a stranded resource into a producing mine. 2 months later, in November, came Vulcan Elements and ReElement Technologies, $700 million in loan capital from Defense, $50 million in equity from Commerce, same issuer, 2 agencies, 1 coordinated capital allocation aimed at building domestic rare earth magnet manufacturing from refined oxide to finished product, vertical integration assembled from federal balance sheets, operating across cabinet departments, with terms negotiated in private, executed without congressional appropriation specific to the deals themselves. By the end of November, in 5 months, the Pentagon and the Commerce Department had directly placed equity in 3 companies, guaranteed a price floor on a strategic mineral, and committed nearly $1 billion of federal capital to private firms operating in extraction, refinement, and component manufacturing. The architecture was no longer experimental, and it had an architect. His name is Steven Feinberg, before the Pentagon. Feinberg was the co-founder of Cerberus Capital Management, $65 billion in assets under management, one of the largest private equity firms in the world. Now Deputy Secretary of Defense, now running the Office of Strategic Capital, now coordinating the newly formed Economic Defense Unit. Semaphore reported in March of this year that Feinberg has been actively recruiting from Goldman Sachs and JP Morgan, not for traditional Pentagon roles, for roles structuring deals, for roles building term sheets, for roles that look identical to the work done at his former firm, except the capital being deployed comes from the federal Treasury and the strategic objective is national security rather than fund return. The Office of Strategic Capital was funded at $1.5 billion in the previous fiscal year. The April 6th budget request asks for $20.2 billion, a 1,247% increase in 1 year. With the explicit mandate to underwrite, equity fund, and price guarantee American mineral and component manufacturing across the supply chain, the plan works, the capital flows, the strategy is coherent, there is no internal contradiction in the design. The expertise is real, the leadership is serious, the urgency is documented. For the first time in 3 decades, the United States has a coherent mineral strategy executed by people who know how to deploy capital at scale. The Treasury is the new arsenal, capital is the new ammunition, and this is where the story breaks, because the architecture that has been built, the price floors, the equity stakes, the multi-agency co-investment, the vertical integration assembled from federal balance sheets, the strategic capital office staffed by Wall Street partners, this architecture is not new in the world. It has a precedent, it has a model, it has 30 years of operational history. It is the model of the People's Republic of China, China's State Reserve Bureau price floors on strategic commodities, state-owned assets supervision and administration commission equity in mining ventures abroad, coordinated capital deployment across ministries with explicit industrial strategic objectives, long-term offtake contracts at administered prices, multi-decade financing for upstream extraction, the integration of state capital with national security planning across the entire mineral supply chain from ore body to finished magnet. Every structural element of what the Pentagon has built between July of 2025 and April of 2026 maps almost one-to-one onto mechanisms that the United States Trade Representative has documented, condemned, and used as the basis for tariff actions against China for 15 years. In March of 2026, the Cato Institute, a libertarian think tank, used a specific phrase to describe the new architecture. They called it a pseudo-sovereign wealth fund controlled by the executive branch. That is the phrase, pseudo-sovereign wealth fund controlled by the executive branch. And the most uncomfortable part isn't that the United States is copying China's playbook. It's that there was no other option left. 3 decades of decisions made that inevitable. The receipts are public. The Treasury is the new arsenal. Capital is the new ammunition. The trap is temporal, and it is closing. The National Defense Stockpile, at its Cold War peak, held materials valued at $42 billion in inflation-adjusted terms. Today, the stockpile holds less than $1 billion. Across 30 years of post-Cold War decisions, the United States chose efficiency over redundancy. It chose markets over reserves. It chose Freeport-McMoRan, an American company, selling 2 of the largest cobalt operations in the Democratic Republic of Congo to a Chinese state-linked firm for a combined $5.65 billion across 2016 and 2020. Each decision rational in isolation, each decision compounding. The Government Accountability Office estimates $18.5 billion to restore basic supply across the strategic mineral inventory. The architecture being built is supposed to close that gap. But the legal authority funding it, Defense Production Act Title III, expires in September of this year. The $20.2 billion request requires reauthorization, congressional approval, sustained political will across an electoral cycle that is already destabilizing the planning horizon. China suspended the rare earth export controls until November 2026. That is suspension. It is not cancellation. The pause is operating as a strategic gift of time, allowing American capital to deploy without the maximum disruption that controlled exports could impose on the existing supply chain. The window is precisely sized to test whether the architecture can be built before the controls return. If the controls return before the architecture is functional, the United States faces forced procurement at controlled prices. If the architecture is functional, China loses the leverage that took 30 years to accumulate. Both outcomes are documented possibilities. Neither is certain. The difference between them is being decided in budget cycles, congressional votes, and capital deployment timelines that operate on horizons of months. Inside that compressed window, the system is doing what no American institution has done in 8 decades. It is building in public with documented receipts, the exact economic architecture that American foreign policy has spent a generation describing as illegitimate when practiced by a strategic adversary. The system is not broken. It is working exactly as designed. For those who designed it, the design is recent, the architects are named, the capital is flowing, the mechanism is documented, the contradiction is structural, and it is being resolved by abandoning the doctrine, not the practice. The Treasury is the new arsenal, capital is the new ammunition, the system keeps moving. So do we. Until next time, question the architecture.